Welcome back to the Deep Dive. Today, we're plunging pretty deep into the digital infrastructure layer.
Those are.
We're looking at the dominant decentralized Oracle network, which is, of course, Chainlink.
Of course.
And this isn't just some crypto curiosity anymore, is it? I mean, This is the vital bridge. It's connecting that, volatile, exciting world of smart contracts to the very cautious, very compliant, and frankly, massive world of traditional finance.
And that connection, it's already generating just an overwhelming scale. I mean, we are looking at a platform that has secured and enabled, get this, tens of trillions in transaction value.
Tens of trillions. That's a staggering number.
It is. And now it's being integrated by institutional heavyweights. We're talking Swift, JP Morgan. They're using it to handle these really sophisticated multi-asset workflows.
So our mission today is really to give you the shortcut. We're going to unpack the tech, understand why it moved from simple price feeds to a full-on computation platform.
Yeah. And see how its unique economics, the whole staking model, is securing these incredibly valuable enterprise applications.
The real takeaway here, I think, even before we start, is that Chainlink sort of pivoted. It went from being a price feed vendor for crypto traders to becoming the compliance layer, the thing that allows a company like JP Morgan to even talk to a permissionless blockchain.
Precisely. We're mapping a massive pivot here.
Okay, let's unpack this core problem that Chainlink was fundamentally built to solve. What is the foundational limitation of a blockchain that even requires an oracle to exist in the first place?
Well, it really all comes down to security and isolation.
Right.
Blockchains are, by their very design, incredibly secure. But to get that security, they have to be isolated. A good way to think of it is like a highly secure computer with absolutely no internet connection.
Right, so it's a closed system.
It's a closed system. And that isolation is what makes them so reliable, so deterministic. The whole network only has to agree on data that's already inside its own secure ledger.
Yeah, they can verify signatures, they can check balances perfectly, but they're only dealing in what you might call on-chain truths.
Exactly.
But the second a smart contract wants to do something really useful, give a complex derivative or an automated insurance policy or settle real-world trade documents, it just hits a wall.
It hits a wall because it needs external real-world data. It needs verified market prices or proof that a shipment arrived or even election results.
And that's the gap.
That is the gap. Our sources suggest that for smart contracts to realize, upwards of 90% of their potential use cases, they must securely connect to the outside world. And that's where the blockchain oracle comes in.
So the oracle is the bridge.
It's secure middleware. Yeah. It acts as the communication link between what's on-chain, the smart contracts, and all the off-chain systems. The APIs, the enterprise databases, the payment systems.
But here's the catch, right? If you just use a single traditional oracle, you're basically reintroducing the exact same centralized risk.
The single point of failure.
The single point of failure that you use the blockchain to avoid in the first place. It sort of defeats the whole purpose.
You've absolutely hit the nail on the head. That single point of failure is incredibly dangerous. If that one oracle goes down or gets hacked or is corrupted,
and the whole contract is compromised.
Instantly compromised. And that risk is just completely unacceptable when you're securing billions, let alone trillions of dollars. Chainlink's answer, which came from Sergey Nazarov, Steve Ellis, and Ari Jules, was the decentralized Oracle network.
A DAWN.
DAWN.
So the DAWN structure is basically doing for external data what a blockchain does for transactions. It's generating those same guarantees of security and reliability, but for, information retrieval.
It is redundancy by design. It ensures decentralization, not just at the node operator level, but across multiple independent data sources. No single party can be a point of failure.
Which is what enterprises need.
It provides the strong guarantees that they demand. Data will be delivered on time. It will be accurate because it's aggregated, and it will be resistant to manipulation. The network formally launched back in 2019, and that concept is what really set it on this path to infrastructure dominance.
Let's transition into the technology then, because Chainlink has moved so far beyond just fetching a price feed for Bitcoin. It's really a comprehensive off-chain computation platform now. So what does the full job description of a DAWN look like today?
It's much more complex than people think. A DAWN really has 4 main stages. First, it has to listen. It's constantly monitoring the blockchain for a specific smart contract request.
Okay, so it's waiting for a job.
Waiting for a job. Second, it extracts data. Not just from one API, but securely from multiple different systems. Third, and this is the crucial part, it has to compute. It performs secure off-chain functions.
Like what? What's an example of computation?
It might be calculating the median price from 10 different sources, or it could be running really complex algorithms. Finally, it broadcasts the result, the data, or the cryptographic proof back on-chain.
That computation layer is really what makes it so versatile. Let's talk about two huge technical innovations here that show that complexity. First, the ability to generate verifiable randomness. That's massive for gaming, right?
Oh, the verifiable random function, or VRF. It completely solves the trust problem in digital luck.
Right.
If you're building a high-stakes lottery or an NFT drop, your users have to trust that the randomness used to pick the winner wasn't tampered with.
That the house isn't cheating.
Exactly. VRF generates a cryptographic proof that the result was genuinely random and anyone can verify it on the blockchain. It's like ensuring the dice roll is fair and then giving everyone a cryptographic receipt that proves it.
Okay, here's where it gets really interesting for me. They're also building tools that solve the ultimate institutional problem: privacy and confidentiality. I'm talking about DECO.
DECO is a total game changer. It came out of a Cornell research project, and it integrates zero-knowledge proofs, or ZKPs.
And that solves a huge contradiction.
A fundamental one. Smart contracts need verified information, but financial institutions absolutely cannot expose their sensitive data on a public ledger.
So give us the quick, accessible analogy for that.
Okay, think of it this way. A ZKP lets you cryptographically prove that a statement is true without revealing the underlying source data. It's like proving to a bouncer you're over 21 without actually showing them your ID with your address and your exact birth date on it.
So the Oracle just sees the proof, not the data.
The Oracle verifies the proof of truth without ever handling the private information itself. And that level of confidentiality is just non-negotiable for traditional finance.
So if privacy is one pillar, the other has to be connectivity. And nothing screams connectivity like the Cross-Chain Interoperability Protocol, CCIP.
CCIP is. I would argue it's the key piece of middleware that unlocks trillions in institutional value. It's an open standard designed to transfer both data and value like actual token transfers, seamlessly and securely across all these different blockchains. Public, private, permissioned.
It's the universal translator.
If the blockchain world is the Tower of Babel, CCIP is the missing diplomatic translator.
Exactly.
And that distinction you made, data and value, that's so important. It means a contract on, say, Ethereum can tell a contract on a private JP Morgan network to go and settle funds, and Chainlink guarantees the security of that whole message flow.
Precisely. And this shift is what takes Chainlink from being just a basic data bridge, what we call Chainlink 1.0, to a fully fledged cross-chain development platform. Chainlink 2.0. Okay. The core goal of 2.0 is to augment smart contracts using what they call hybrid smart contracts. They securely combine the on-chain logic with the rich, compliant, off-chain data and systems that real-world businesses actually rely on.
And to get the trust of an S&P Global or a Swift, you need more than just good code. You need compliance credentials. Oh, absolutely. That's why achieving institutional-grade operational excellence was so essential for them. They went out and got ISO 27001 certification and a SOC2 Type 1 attestation.
And these are the big ones.
These are the security and operational resilience certifications that global banks and financial infrastructure providers look for. It's a stamp that says they meet the highest standards for handling sensitive data and maintaining continuous operations.
Okay, let's talk about the massive gravity well that Chainlink has become in terms of adoption. The scale is it's truly staggering. Remind us of the metrics.
The numbers are almost hard to contextualize because they're so large. The infrastructure has secured and enabled tens of trillions in transaction value over its lifetime.
Tens of trillions.
And right now, as we speak, it secures over $90 billion in total value in DeFi. It is the undisputed market leader in the Oracle space. There's no one even close.
But the real validation isn't the crypto market anymore. It's the giants of legacy finance. How did Chainlink manage to earn the trust of the institution that powers, 90% of global cross-border payments, Swift?
Swift is the ultimate validation. I mean, they're actively collaborating with Chainlink in, I think it's over a dozen leading financial institutions.
Wow.
And they're testing how their existing legacy messaging standard, the one used by 11,500 banks, can seamlessly interoperate with all these different blockchain networks using CCIP.
So this isn't just a pilot.
No, this is an attempt to connect the entire existing financial world to the future of tokenization, all through a single trusted interface.
But when we look at complex settlement, that's where JP Morgan comes in. right? They're moving beyond theory into real atomic transactions.
Precisely. JP Morgan has used Chainlink's infrastructure for these really complex delivery versus payment DVP and payment versus payment or PVP settlement workflows.
Can you give us a specific example?
Sure. The big one is the cross-chain atomic settlement between JP Morgan's own Connexus network, which is their proprietary permission chain, and Ondo Finance's tokenized U.S. Treasuries fund.
Okay, why does that specific transaction matter so much?
It matters because it involved two entirely different types of digital assets on two entirely different blockchain environments. You need a trusted third party, a trusted data and communication layer to orchestrate that transaction securely and atomically.
And that was Chainlink.
Chainlink, through CCIP, served as the connective tissue and the trust guarantor for that whole multi-system, multi-asset movement.
And we are seeing that deep integration across the entire tokenized asset universe, which, a lot of people see as the future of finance.
It's the core use case now. You see Fidelity International and UBS Asset Management using Chainlink to service tokenized funds, making sure crucial data like net asset value in an EV is brought on-chain accurately.
Right.
You also see major institutions like ANZ Bank using CCIP for cross-chain settlement of digital currencies like CBDCs and stablecoins. And then the data providers themselves, like S&P Global and FTSE Russell, are using the infrastructure to bring their index data and risk ratings directly onto the blockchain for smart contracts to use.
This is starting to sound less like a decentralized Oracle network and more like the foundational operating system for global tokenized finance.
That is the endgame vision from the source material. They are positioning Chainlink as the industry's TCP/IP and JRE standard.
Unpack that for us.
Well, TCP/IP standardized how information moved on the internet. The Java Runtime Environment, JRE, standardized how applications executed. Chainlink wants to be that all-in-one Oracle platform that simplifies every complex multi-asset, multi-chain workflow. It just abstracts away all the complexity for global finance.
That scale is overwhelming. And securing trillions of dollars of value requires a serious engine room. So that brings us to the economic security of the network, the Link token itself. What's its core utility?
So LANE, which is an ERC-677 token, but it's fully compatible with ERC-20, is the native crypto used for economic incentivization. It has two main roles. First, it compensates the node operators for their computation and their data delivery services. And second, and this is critical for security, it serves as the required deposit or collateral that those operators have to put up. It assures contract creators that the service will be performed reliably.
Which leads us into Chainlink Economics 2.0 and the crucial implementation of staking. How does staking provide this new necessary layer of crypto economic security?
Staking introduces crypto economic alignment. It's money on the line. The latest version, Staking V0.2, significantly expanded the capacity. The initial cap is now 45 million LINK.
And it's rolling out in phases.
Yeah, in phases to ensure a wide distributed participation. The goal isn't just to reward holders, it's about having a dedicated pool of collateral ready to cover potential losses if an oracle fails.
So let's get really clear on the risk structure here. If I'm a node operator, what's the consequence of failure? And if I'm just a community member staking to support the network, what's my risk?
And that's a key distinction the sources really emphasize. The node operator stakers, the ones serving the high-value services like the Ethos data feed, they are subject to slashing.
So a penalty.
A severe penalty. If they fail to meet specific performance requirements, they face a penalty of around 700 link. This provides a tangible financial guarantee of service reliability.
And for community members.
Community stakers, importantly, are not at risk of slashing in V0.2. They earn rewards simply for backing the performance of the services, which contributes to the overall stability and the collateral pool.
Okay, that makes sense. But for enterprises using the network, the friction of having to buy and pay in a volatile crypto asset must be a hurdle. How does Chainlink deal with that payment challenge?
That's where a really ingenious mechanism called payment abstraction comes in. It's designed to drastically reduce friction for large users. It allows them to pay for Chainlink services in whatever asset they prefer.
So ETH or USDC?
ETH, USDC, future stablecoins, you name it. They don't have to manage link price volatility just for their operational costs.
And what happens to that revenue? Where does the ETH or USDC go?
So those revenues are programmatically converted into Link using a decentralized exchange mechanism, and then they're channeled into something called the Chainlink Reserve.
And the reserve is for?
It's a strategic mechanism. It's funded directly by user fees, and it's designed to support the network's long-term growth, pay out staking rewards, and ensure the whole system is economically sustainable, totally independent of new link emissions.
So we've walked through the problem, the hybrid technology, the tens of trillions in institutional adoption, and this crypto economic security model powered by link and staking. What does this all really mean for you, the listener?
I think it means you should view Chainlink through the lens of critical infrastructure, not just another crypto project. It's the complex, highly secured plumbing that's enabling the tokenized financial future.
It's the plumbing.
It's the plumbing. Its compliance credentials and its robust CCIP protocol are the things that finally allow the vast, highly regulated legacy financial world to even consider moving multi-asset workflows on-chain in a way that is both secure and compliant.
And if we look at the long-term outlook, particularly through that lens of capturing the infrastructure layer, the sources we've seen indicate some pretty significant expectations for the value of the LinkK token itself.
That's right. The sources really emphasize that the path to higher valuations relies completely on continued deep enterprise integration and CCIP adoption becoming the default standard.
So what's the number?
The moderate price prediction provided for 2030, based on analysts' expectations that oracles will become vital, highly valued infrastructure, ranges between $120 and $180 per LinkK token. This valuation reflects the utility of becoming the dominant intermediary for all of global finance.
That potential is just immense. So here's the final thought. If Chainlink successfully becomes this TCP/IP standard for finance, and it's enabling trillions in tokenized asset transfers across all these diverse systems, what new, currently unimaginable financial products will the world be able to build on top of this standardized, trustworthy connection layer?
That really is the ultimate question, isn't it? The creation of a standardized, compliant, and interoperable connection layer, it just removes all the barriers that fragmented legacy systems always imposed. Imagine being able to seamlessly bundle tokenized real estate assets from one country with tokenized corporate debt from another, secured by verifiable off-chain data, all executed atomically with smart contracts. The financial world can finally move beyond just digitizing old assets and start constructing entirely novel, complex, high-frequency, multi-jurisdictional products tailored exactly to institutional needs, all leveraging a level of trust that was previously just impossible.